So I'm Lisa and I run economics design, and we do a lot of design of these token systems. And the reason why we want to design these token systems is because we want to be able to measure and then improve the token models that facilitate transactions within your ecosystem. So to explain how we usually work with projects, we do analytics, but also we have a lot of chats with anyone in the space building very cool products and have different kind of Twitter sessions or Discord sessions and share them with public. And today we're talking with dHEDGE. So today, the general agenda that we're looking at is firstly going through a general introduction of you, Jake, who is with dHEDGE. The second is understanding a little bit more about what dHEDGE does, understanding the different components of how the protocol works. Then we'll dive into the token a little bit more and understand what the dHEDGE token is about. Then we want to understand a little bit more of any updates that you have within the dHEDGE space, because I know you just introduced some new updates. And lastly, some other concluding comments about dHEDGE. So without further ado, Jake, would you like to introduce yourself?
Yeah, absolutely. Yes, I've been with dHEDGE for about 6 months. I've got an engineering and computer science background, and currently taking a data science master's at UNSW. And yeah, my career's taken me through traditional finance at RBS, but in investment banking, I think over 10 years ago, through to fintech. I worked sort of across the fintech space for a couple of years in Australia, and now into full-time DeFi, which is very exciting and fast-moving space.
What got you into DeFi? How did you move from traditional banks to the DGen?
Well, I wouldn't call myself a DGen. I don't know. I think what when I was in banking, I got a little bit frustrated with some of the. It felt slow to me a little bit. Like there was a lot of sort of halfway between commercial banking and investment banking, and doing sort of debt issuance. And I don't know, I just sort of gradually moved my career from traditional banking through to the digital space very quickly. So into fintech and digital marketing and helping a robo-advisor in Australia grow their business. And DeFi became very attractive because of the governance structures and DAOs and how DAOs work. I got very interested in that. And yeah, just the rate of change of the space and how quickly new solutions pop up and how they're solving problems that traditional finance hasn't overcome.
So I think that's very interesting because dHEDGE has a huge connection with what like robo-advisors are doing or what traditional banks typically want to do. So can you share a little bit more about what dHEDGE does and what problems are they trying to solve?
Yeah, sure. I mean, dHEDGE is a platform. You can think about it as a marketplace. It's essentially infrastructure that connects investors to fund managers, whether those fund managers are active people who are running their own accounts or whether they are automated strategies or even bot managers. It allows anyone the access to parts of finance that maybe in traditional worlds you had to be an accredited investor to get into, or you had to have a certain amount of net worth to get into. And so DeFi and dHEDGE allow this situation where anyone with a Ethereum wallet can connect to the platform and pick a manager and invest in a pool.
Yeah, and I think that's what I love so much about the DeFi space, because it really gives access to any tools and infrastructure and products available to people. And in traditional finance, you only have institutional investors or accredited investors having access to these different tools, platforms, and products. With DeFi, it really democratizes everything. With that being said, the reason why in traditional finance you have all these barriers to entry is because these products are very, very risky. So by opening it up to anyone to come in and use these products and services, how do you look at risk? How do you look at educating the users, the retail guys, to understand what kind of risks are at stake?
Yeah, it's a good question, because I mean, often in DeFi, people tend to be anonymous, and it's hard to build up a relationship with someone who you're allocating your capital to manage. And so we try to make that a little bit less, increase the transparency around that by having managers can connect their accounts to their Twitter account so that you can get sort of a history of the person's Twitter thinking through their career. And then we also score each fund or each pool using a Sortino ratio, which is essentially a ratio of the downside volatility that the pool has exhibited against the market as a sort of standard deviation. And then we score that out of 5. So as an investor, you can come to the protocol and try to limit your investor range just to pools that have very low Sortino ratios, instead of picking a risky one, just to try to guide the investor behavior.
So dHEDGE is basically an asset portfolio management platform, and it's completely open, decentralized. Anyone can become a portfolio manager, and other people can see if you seem to have good strategies or you seem to have good thinking. I'll put money with you. The thing is, these things are quite dangerous, so you guys have your own ways of figuring out how to calculate and define the risk, and that will be understanding the pool, your strategy, against the entire market and comparing that. Now, we can figure out what the volatility of the pool is, how the prices move, how it impacts, how these different strategies impact the volume or volatility of the pool. But what about the market? How do you define the market in this sense?
That's a good question. Some ways we help the investors on how to do that is when you're on the platform and you click into a pool, we provide indices against the pool's performance history. One index is the Ethereum price, and the other one is the Bitcoin price. So you can see if a manager very quickly has either outperformed ETH or outperformed Bitcoin over the period of the chart. I mean, it's not a perfect approximation for the market, but they're probably the 2 leading indicators of obviously market cap in the crypto space. So there are 2 ways we help the investors with that. But yeah, it's a hard one to answer because you get subsets of markets that are more relevant to different portfolios, obviously based on the composition of assets they're trading with. So it's a hard one to really have a black and white answer to.
So if let's say you're given all the information and you have all the data available, how would you structure this market, the volatility of the market that will become a good metric and proxy to compare against the volatility of the pool, so you can give people better understanding and insights to how risky this strategy is?
Yeah, well, that's the Sortino ratio. Like you pretty much defined it in that question. So that's a market indicator that is basically a ratio of the downside volatility against the risk-free return of the market. And so we help users by taking that score and turning it into sort of a traffic light 1 to 5 risks. So if a pool is rated risk 5 out of 5, then it's perceived to be a risky pool versus a more conservative 1 out of 5.
Yeah, so I agree with that. And I think what I was asking is a bit more, can you define the market a bit more specifically given the strategies in place? So for example, if the strategy is just longing and shorting Bitcoin, then your market will definitely be related to the market cap of Bitcoin and Ethereum. But if your strategy is, let's say, just doing stablecoins, different types of stablecoins, so very, very low risk, just understanding stablecoins, you do arbitrage between the prices, then looking at the value or market cap of Bitcoin and Ethereum might not be the best way to explain what the market risk is.
Yeah, that is a good question. I think there's only so much you can provide in a user interface to new investors to help measure the performance of a pool, because say for instance a manager has the ability to choose a suite of assets that they're going to be putting into the fund, whether that fund is on Ethereum, or it's on Optimism, or it's on Polygon. We have different suites of assets. And so each manager will have their own investment strategy that they communicate to the investors through a panel on their investor page that contains, they can put a whole bio in there, or they can communicate to investors and they can talk to them. And so there's ways that the investors can add more color to the managers can add more color to the investor community through direct communication on their decision-making process. But with respect to helping the investors as like an index or a market ratio, then I think the Sortino one is the only one we put in as a formal measurement.
Interesting. So I'm just asking because I'm curious about this, because on our side, we've been looking at figuring out how do we define market volatility. And we look at trying to create a volatility and health data or health indicator to understand how do we even define what the crypto market is, right? And the crypto market is a lot more than just the top 10 trading tokens and trading assets, and understanding how we want to, figuring out how do we remove survivorship bias as well to give us a better understanding and representation of what the market is, will be quite important in determining if a strategy is good or not. So love to. That's why very interested to hear from you guys.
It's a great question, and it's a really good question, and one that we could probably do a lot more work on with respect to helping to indicate whether a fund is outperforming the market or underperforming it, and to help investors like that. But I think that's, there's lots of problems that we're trying to solve in the space, and we've got a vision at dHEDGE that we're building a future where everyone has simple and reliable access to financial freedom so that society's quality of life is improved. And I think, Lisa, to your point, that providing a very sort of clear metric as to the performance history of a fund and whether it's relatively conservative or not, and depending on, that comes back to the robo-advisor conversation on trying to assess someone's risk appetite based on their investment goals and their savings history, and trying to link that to a risk appetite in a pool, I think is a very sort of complex thing to automate. And so you have to give an investor as many tools as possible to help them with their decision, but ultimately the investor has to wear the risk at the end of the day.
I agree. So on that note of risk, and on that note of the various kind of tools and products available to investors, what kind of strategies do you see when it comes to the dHEDGE portfolios that's created by these managers?
We see a wide gamut. We see automated strategies. Like, for instance, dHEDGE has its own software development kit that managers can use to automate strategies. And so we have stablecoin specific portfolios, and then there's traders have the ability, or managers have the ability now to use leverage tokens. So dHEDGE incubated a protocol towards the end of last year called Toros Finance, and Toros provides tokenized structured products. So you can quickly buy, say, a 3x Ethereum bull token or a 2x Bitcoin bear token, and add these to your portfolio so that you can add leverage in a very quick way. We also have integrations with protocols like Aave, where you can have lending or borrowing as part of your portfolio. So the whole sort of suite of DeFi applications you can pull into a dHEDGE fund.
Oh, that's really interesting to know that you can do, your leverage positions with dHEDGE, because right now leverage positions are typically offered by centralized exchanges, and moving into a DeFi space, building these products on a decentralized protocol and platform will be very important and key, actually.
Absolutely.
So on that note, one of the things with everything being on chain is that, firstly, it's completely public. So can someone just steal the strategy or execute it in a different volume? And the second thing is, what kind of risks are there involved in having everything and every strategy on chain and public? I mean, hedge funds do not put their strategies on chain, right? Or they do not just share it in public. So what kind of risks are we looking at when we have everything on chain?
Geez, you got great questions, Lisa. Really good questions. I think that there's benefits and risks with having a fully transparent track record, because one of the main reasons people would seek this out is because a manager can create a very transparent and persistent track record that they can build up on blockchain and trade for 1 or 2 years and have a proven performance history that they can then take to, say, an employer and demonstrate their background. So there's obviously huge benefits from the management point of view. But there are, I mean, I wouldn't say it's risks, but the question of copy trading can pop up, and whether managers can try to influence if a manager is suddenly in control of quite a large pool of assets relative to their own position, then there's risks due to trying to ride slippage of trades to get ahead of positions before trading them. So, but the way that the dHEDGE protocol works is it's totally non-custodial. So, as an investor, when I commit my capital or assets to a pool, the trader can obviously guide and allocate that assets in the way that they want their portfolio. But at any point in time, I, as an investor, can withdraw my assets after an initial 24-hour lockup period. So dHEDGE has that as a point of value, that at any point, if an investor wants to withdraw their assets, that they can.
Interesting. So I think that's great. Having everything on chain, everything public, you have a very good track record of the portfolio manager itself. And this will be fantastic for hiring these portfolio managers. Any VCs or any funds are interested, they can hire them that way. So that's great for the portfolio managers. And so that could potentially reduce their incentive to want to cheat anyone that comes into the pool, because this is public information, this is public reputation. And public reputation is hard to build, easy to destroy.
Exactly.
So there will be less risk of doing that.
Which is why we encourage managers to tie their funds to their Twitter profile or their sort of social media profile in a way that lends any credibility or reputation that they've built up from their social media into the fund that they're managing, so that investors have some confidence or a layer of confidence in who's managing the assets that the investors are committing to the pool.
I agree. And I think with all of that in place, the key direct agents that are economic agents involved in every strategy and key transactions in the space, they all make sense. So far, so good. One of this other risks that I think could potentially exist is your secondary economic participants or economic agents. What is that? With all these strategies in place, again, these are all public. These are all available online and on chain, and we can see what the strategy is, and we can see how much is being added into these pools. So someone could come in and take all this information, aggregate all these different data or these different strategies, run some simulation, and understand for a 10% drop in Ethereum prices, what will these different pools execute, because these are automated. What will they do? What is the value or the volume of trade that is in these pools right now? And how can they front run that? So it's not the front run in the typical smart contract way, but front running trade in the traditional finance way. What do you think about that risk?
I mean, you could apply that logic to the entire blockchain, because someone who has the capacity to run those analytics on a protocol like dHEDGE would then be able to run the same analysis on the whole blockchain. And so then you're looking at, well, what sort of assets would someone need to be able to deploy to try to influence a front-running strategy at that level of magnitude? And I think that there are mechanisms in place. I mean, I don't think dHEDGE would be a target for something like that, to be honest, because you've got like concentrated liquidity on all the AMMs and decentralized exchanges that would have a much higher level of trading activity to analyze and to try to influence. And I think the capital that like an actor would need to have access to take advantage of that level of front-running behavior would be so significant that it's unrealistic.
Makes sense. Okay. Yeah, I didn't want to bring concentrated liquidity up because the amount of risk there,
Right.
it's just
Right.
insane. It's insane. I don't understand that, but great. Okay, so basically to summarize dHEDGE, it's an open source, decentralized, on-chain portfolio management tool, and anyone can come in to be a portfolio manager. You can look at the strategy, define what your strategy is, put it using the SDK or using the tool that you have, put it out, and you can put your own money in. Other people can put their own money in, and it trades automatically. So that's all great. That's wonderful. And decentralized, this is all in line with the philosophy of decentralization in DeFi.
Right. Well,
now, let's talk a little
bit. It can trade automatically or manually based on your own intentions of how you want to run the pool.
If you do it manually, how do you bind these strategies to, like, how do you make it binding? Because if you do it manually, can the portfolio manager say that, okay, I promised to short Bitcoin, but I decided not to? And isn't that cheating?
Absolutely. No, like it's not cheating. It's a manager can, I mean, that's the nature of active management, that at any given time, a manager can make a decision, and if they back their instinct, or if the decision matches their strategy, then they can do that. And so you as an investor are allocating a certain amount of trust to the decisions that manager's going to make. And the way we try to give insight into the background of that manager's history is just by showing the performance history. So the mechanisms the manager has to communicate with the investor pool are through a direct messaging system on dHEDGE. There's also a public wall where they can make comments. And there's also obviously the manager's Twitter account. But yeah, active management. But absolutely, the managers can just decide on a whim if they want to make a trade.
That's fun. So actually, this will be, whoever then understands options enough can definitely actively manage concentrated liquidity positions on Uniswap V3. Because if you can have good amount of your high returns, but this high returns is high because the risks on Uniswap V3 is just insanely huge. But if you can actively manage that, you could potentially minimize your IL and actually make profits out of it.
Exactly. Absolutely. And so that's the thinking behind the Uniswap integration, which we launched on Tuesday this week, Tuesday on the Asian time zone. So for funds on the Polygon and Optimism chains, managers now can have managed liquidity positions on Uniswap that they actively manage, either manually, so like logging in on a daily basis and updating the ranges, or by setting an automated bot to do that for them, which is done through the SDK.
Interesting. Okay, so I want to talk about that later because I want to talk about the token first. But you know what? Let's talk about this product update first before we can talk about the token later. So walk us through what is this new update that is being done. So from what I understand, correct me if I'm wrong, this is going to be done on much cheaper EVMs, so you don't have to pay insane gas fees to be changing the positions. And basically now Uniswap V3 liquidity providers can be allocating their liquidity to portfolio managers, and portfolio managers just manage your positions.
Yes, exactly. So yeah, well, firstly, the product release, we called it Aurora because we have a theme of naming product releases of sort of terrestrial phenomena. So the previous one was Horizons, and this one's Aurora. The next one will be Moonlight. And yeah, so it as you've touched on, managing Uni V3 liquidity can become either costly, or you can suffer from impermanent loss very, very quickly if you're not actively managing the position. And so dHEDGE is quite an innovative solution where if a fund manager wants to open a fund and all they're doing in that fund is managing a liquidity position very tightly, then investors can add their funds to this pool and have it managed by someone versus trying to manage it themselves on Uniswap. And so there's a level of convenience there that if you see that the manager's been doing a good job of running this pool, then it's a great service to have someone manage the liquidity for you. And so as a fee, the manager can charge any percentage they'd like, and that's transparent on the platform, so they can charge 2% or 5% or what have you. And yeah, so it's a service that's good for managers, and it's also a service good for DAOs, because if a DAO has a treasury where they have a portion that they are managing on Uniswap, then they can use dHEDGE to allocate portions of treasury to different traders to manage for the DAO in a very secure manner.
Yeah, that makes sense. I think there's a lot of DAOs waiting for services like that to manage the treasury, because there's just a huge amount of funds in a DAO waiting to be deployed or just be put to good use.
Yeah, absolutely.
So on that note of V3, that's a very interesting thing, because I'm looking at just calculating the risks of concentrated liquidity pools, or just AMMs in general. So yes, you can be actively managing your positions on Uniswap V3, but what are you minimizing there? What are you optimizing? Your optimization function in that way is to reduce your impermanent loss. And whereas the alternative for that, what you could optimize is to optimize for, say, when prices are volatile, hence moving your positions, you can use whatever assets you have to purchase the asset of a lower value. So not only do you manage your position, but you can also be buying these assets at a lower price and take advantage of volatility. But just by managing positions, which you have mentioned, it simply reduces IL. But what are the upsides that could potentially happen that we're not seeing right now?
That's another great question. The upsides of the V3 managed liquidity positions?
Correct.
Well, I mean, if a position's managed tightly enough, then you're going to improve your capital efficiency. So ideally...
Yeah, but your capital efficiency is capped on the trading volume as well as the trading fees that you can get. Like, it's limited, it's not like an option position where you could have unlimited upside and limited downside. Here, because IL is unlimited downside, the upside just seems a bit limited. So, what can be done as a manager, for instance, to increase upside for users?
Well, I think if the manager has a strong insight into the direction the market's moving, then they can have more tolerance on one side of the price action to anticipate that. And maybe that comes back to manager skill, and that'll try to reduce IL versus a manager who is, say, 50-50 split on the range of price action. I suppose that's one way a manager could demonstrate value to an investor. But then again, you could have a fund on dHEDGE that is comprised of multiple different uni pools, so multiple different positions. I think we're maxing out at 3 at the moment. That might have been just in testing, but that you could then invest in a portfolio of managed liquidity positions and increase upside in the return you're getting from those assets.
Okay, makes sense. So basically, the new product that's been introduced, the Aurora, is allowing users to actively manage positions for concentrated liquidity on much cheaper EVMs. So you can really do active management and not worry too much about the cost of these transactions.
Correct.
Yes. Great. So far we've talked about what dHEDGE has done, or what dHEDGE is doing, and what the new improvement of dHEDGE is. Now I want to touch a little bit more about tokens, because in this space right now, everything is tokenized. So when it comes to decentralized asset management, you might not always need tokens, right? This thing can work perfectly with USDC or SUSD that you have right now, and all the other assets available. So why do you have a token? What kind of value does the token bring?
Yeah, it's a good question. I think the dHEDGE token, it's called DHT, has sort of 2 main functions, and one is governance, and the other one is sort of a way to encourage good investing behavior. So the way that the token does that is the protocol aims to give incentives for specific funds that have demonstrated good track record, so that it's more lucrative for an investor to choose a fund that is getting the additional rewards in DHT versus one that isn't. So the way that we decide on which pools earn these rewards is based on their sort of investing history and Sortino ratio and other factors. But ultimately, it's a way of sort of guiding and rewarding investors for participating in pools that are great pools and great investing opportunities. And then on the governance side, so as a dHEDGE being a DAO, we have a whole governance process that other DAOs is similar to other DAOs in a way that you can take the DHT token and stake it, and then have a governance share and vote on protocol improvements and how stakers are incentivized and rewarded on a monthly and quarterly basis.
Okay, so there are two functions of the tokens, or two utility functions of the DHT, which is the DHT token. The first one is to incentivize good behaviors. The second is governance. Right. Let's dive a little bit deeper into incentivizing good behaviors. Right. The good behaviors you mentioned is for funds with good track records to come on, to create good strategies or to come on board. And the way to measure this outcome, to measure that they're good, is basically their returns, right? It's a very direct way. This is your input strategy. Your output is your ROI.
Yes. Yeah.
That being said, so your DHT is going to be used to incentivize these funds with good track records. Now, because the output is it's just ROI. You can't fake that. You just calculate that. Why doesn't the market decide this? Why do we need additional tokens to incentivize these good behaviors? Because the market naturally is looking for higher APYs. Right. So wouldn't the market and the retail guys just naturally put money into assets with strategies with high APYs? And you don't need your DHT to come in to incentivize that.
Yeah, no, it's a good question. I mean, it's a way of incentivizing people to use the protocol and rewarding them for that usage. And I think that APY isn't the only variable that we use to decide on which of the pool. We call it performance mining. So that's the vehicle that DHT is rewarded to investors. I think that as a marketplace, if you've got a manager that's charging a fee for a service and investors are paying that fee, then the way that we can either compensate them for the fee or incentivize the whole ecosystem is by issuing that DHT from emissions and adding value to the relationship.
Yeah, that makes sense, because especially when you talk about the key input, in economics we have factors of production. So the value of a house, or the factor of production, is the labor and also the land that the house is on. So in this case, this token that we talk about, this DHT, the factors of production is your performance mining. And when it comes to the utility, that's the inflation rate inflation of DHT as well. And then how do you use DHT? It's when it's being used to govern and stake these tokens. So now these tokens become a proxy for your performance, meaning you use the product, you understand the product, and because of that, you can now have a better way to quantify someone's reputation or qualify someone's reputation enough so that they can use these tokens to stake for governance changes.
Yeah, absolutely.
So when it comes to governance changes, what kind of things can be changed? Because right now, the positions and strategies are all managed by portfolio managers. So what can a user change? What can they change? What would they want to change?
Good, great question. I've just walked through some examples of how the protocol's changed over time. Let's say at the moment, dHEDGE has a product called the dHEDGE stablecoin yield token. It's called DUSD. And so what that pool does is it takes the assets in the pool and farms stablecoin incentives on liquidity providing platforms on Polygon. So I think it's limited at the moment to SushiSwap and Balancer. And so only allocate capital to stablecoin yields. At the moment, that token is a dHEDGE pool on dHEDGE, and there's a proposal at the moment in the forum to move that pool to the Toros protocol that dHEDGE is growing off. And so that's an opportunity for a governance vote for governance to decide whether or not that pool should sit in Toros or it should stay with dHEDGE. It's just an example of how the protocol is growing and how it's trying to be specific in its purpose, and whether dHEDGE should be specifically a marketplace or it should offer a bunch of structured products internally to it to help investors with say pools that a manager isn't doing themselves. So that's one example. Another example is there's a quarterly disbursement from the protocol treasury of fees that have been earned from managers having good performance and getting a performance fee. And so the protocol takes a portion of that performance fee as a sort of protocol revenue, and that gets dispersed, or some of that gets dispersed to the staking community every quarter. And so the proportion of what's distributed, like you could think of it as like a quarterly dividend, and the proportion of what's distributed is taken as a governance vote every quarter to decide what percentage should be paid out. And so that's one very direct way that a staking investor can have influence on the protocol.
Okay, so here we've talked about the three different components of the token. First, it is minted based on performance by these various portfolio managers. Second, it is being used to stake for governance. And thirdly, it is distributed as a value distribution to various token holders. Now, you mentioned that it's distributed like dividends, okay, that we understand, but the dividends are given to token stakers. And now the question is, what are they staking for? Is that performance-related staking? Is it staking for the sake of staking? Is the staking doing something for them?
So that's a good point. So the performance mining that we went across before goes to every investor that's in a pool that has qualified for performance mining rewards. But there's a cap, there's a maximum amount. So if you're not staking a DHT token, there's a maximum cap of only receiving 100 DHT per month. So a benefit of staking the DHT token is it increases the maximum cap that you can receive in DHT rewards every month. So there's a positive flywheel of trying to keep DHT liquidity in the protocol through staking and rewarding people who are doing that via increased performance mining rewards.
Okay, so people get DHT and because they're great portfolio managers, and then they stake it to get more DHT and more rewards.
Correct.
And then they can use these tokens to make governance changes in governance boards. Do you have any other future plans of increasing the utility or increasing any other functions of the token where there can be other use cases?
No, it's a good question. Some of the models that other platforms use, like for instance, how V-curve is used for in the gauge and trying to decide which pairs on curve receive bigger rewards than others, and trying to maybe work with the ratio of how rewards are dispersed across pools is one idea. We're sort of working through that, but yeah, there's this. It's a wide landscape, isn't it, of how to use governance tokens? Because you want to incentivize community as much as you can, and make sure that the DAO stays healthy and that the DAO is sustainable. And so another thing we've been doing with DHT tokens is issuing bonds in DHT. So offering them in a similar way to how Olympus DAO has been setting up protocol-owned liquidity of offering DHT at a locked-up discount over a period.
Yep, that seems to be the Olympus DAO.
Right, exactly.
It seems to be very popular with
very
users.
Popular. And so that's been pretty successful. Those tranches have been selling out every week.
Yeah, they're successful when it's bull time. I think we should wait a little bit more during the bear market to see how they perform. Just for curiosity's sake, it'll be interesting to see how that works. So, what's next for dHEDGE? You mentioned that there's another project coming up called
Moonlight. Yes. Moonlight, exactly. Yes. Yeah. So
talk a little bit about that.
So what's next for dHEDGE? So we're continuing with our with our expansion onto the Optimism chain. So at the moment on Optimism, managers could only have traded with Quenta, the synthetics based trading platform. And so now we've added Uniswap to that, and with Moonlight, we are going to add 1 inch onto the Optimism chain. So managers have 3 different protocols to engage with. And then also Aave v3 was released today. And so we'll be looking at whether we can integrate Aave on Optimism as well. So that'll be
lots of exciting.
Lots of exciting. The team's really, really pumping out product updates over the last 6 months. It's been a really astonishing time to join dHEDGE. I'm pretty blown away, to be honest.
Super. So where can people find more information about dHEDGE development?
Well, the number one place for community is our Discord, which you've got links to Discord on our homepage at dhedge.org. And then our Twitter account is another source of updates, which is at dHEDGE.org is the handle. So they're the 2 main sources of contact. But yeah, lots of other channels through a forum and Snapshot, all available on the dHEDGE site.
dHEDGE or DHT is a governance token. So do you have some insights on the frequency of governance proposals, the frequency of people voting, the percentage of people using the DHT tokens to vote, and the percentage of any analytics around the governance votes?
That's a really good question. I think to the first part of it, the frequency of proposals is very transparent. Like you can go onto forum.dhedge.org and see the history of DFPs, we call them, so dHEDGE feature proposals, and DCPs, which are called dHEDGE capital proposals. Obviously, suggestions apply to different aspects of the DAO. Just looking at it at the moment, I think there's been 8 proposals in the last 2 weeks, 8 or 9. So it's pretty frequently. But I don't know, to be honest, Lisa, on what proportion of all the DHT holders actually go in and vote. I don't have that information. But that's something that should be useful.
I'm just asking because we're doing a lot of research on DAOs and understanding people's usage and utility of governance tokens. And we just noticed a general trend of pretty much any governance proposal is always a pass. That's number one. Number two, if it's not a pass, people just resubmit the exact same thing. If you submit it 3 times, you know what? The genie will come off the bottle and say it will pass. And there is, as much as tokens are very governance in focus, it is for better or for worse, not really used in the way it's meant to be used. So the proportion of people holding the tokens are not exactly voting for them, and they might be staking to get different returns, but they're not staking to be able to use them and unlock them for governance votes. And this really goes against what the whole decentralization idea is, wherein decentralization in terms of tools, in terms of infrastructure, in terms of users, in terms of portfolio managers, all great. But decision-making is a very important, key, critical aspect to really fulfill this decentralization philosophy that everyone is aligned with. And so far, users are not picking up, are not voting enough. And I wonder why.
Yeah, no, it's a great point. It's a really good point. And I think, everyone wants an active, engaged community because it's healthy for the ecosystem and it breeds sustainability because everyone's connected to a organization that they want to survive, right? The nature though of dHEDGE is that as an asset management platform, a lot of the use cases for some of the investors is a bit of a sort of set and forget mentality in that I don't have the time, as an example, right? So if I know a little about crypto and I want to hold some Bitcoin and Ethereum, why would I pay a manager to hold those 2 for me where I could just hold them myself, right? So that's sort of one reason not to use dHEDGE. But the reason is, well, the investor might be, I don't want to spend a lot of time keeping up with the markets to time my trades, and I want to pay a fee to give to someone else to do that for me. And so in that case, the likelihood of that user of participating in governance and being connected to the protocol frequently is unlikely, because the whole use case in the first place is to offload the responsibility of asset management to someone else. So I think in the case of dHEDGE, you're more likely to have people who aren't going to be that engaged in governance is higher than other protocols. But there's definitely a strong subset of the community that is heavily engaged in the governance. You can see the voting history in Snapshot. But I think that's just maybe one insight as to why it wouldn't be every single investor.
Yeah, I agree with you. I think another important stuff is also that there's just too much information to be aggregated, to be making decisions. It's just really hard to digest the information. There's so much data around.
Yeah.
And with blockchain, data is free, it's transparent, it's available. But how do we make sense of the data? How do we use the data to make informed decisions? That is still something worth up for grabs. Thank you so much, Jake, for chatting about dHEDGE and understanding how dHEDGE works and the various developments in the space. And is there any last thing that you want to mention and you want to talk about?
No, I think I've really enjoyed the conversation tonight, Lisa. Thank you for having me on. And yeah, I think keep an eye out for Toros Finance on from dHEDGE. There's going to be a few interesting product developments there in the short term. So not leaking too much alpha on this call, but yeah, keep an eye on the Toros Twitter account for the next couple of weeks.
Fantastic. Well, thank you, everyone. And this will be uploaded on YouTube as well with more details and all the different links to the dHEDGE community. Till then, I'll speak to you next time. Bye-bye. Thank you so much for staying throughout this entire video. If you're interested to learn more and you want to join the community, do check out our Discord, check out our Academy, and you get to watch these videos for free as well, without any ads. And also grab the book that I've talked about earlier on. The book summarizes a lot of what we're trying to build, what we're trying to design, and the different aspects that can be changed during the entire design process. We also just launched Econteric. Econteric is really economics plus esoteric, because this space is so complicated and so difficult. What we want to do is to make it easier for anyone to come and learn and be part of this system. So in Econteric, we are breaking down the different analytics and different data to give you more insights to understand the robustness from a very fundamental level of the health of this ecosystem. So check out econteric.com and I'll see you there. Bye!